Mr. Market is an old hand now at the sort of political brinkmanship which we're seeing here. So it's not a surprise that the market had looked through it. Although, I suppose to back out your question a little bit, you could say that it was a little bit surprising the markets didn't pull back a little bit more prior to this. There was plenty of opportunity for that, and it hardly flinched at all. So now we passed the hurdle and we've had hardly any reaction. So I think that's a reflection of the first thing, which is that the markets really looked completely through this, which, a few months ago you wouldn't have thought. But as I said, I think it's a reflection of the fact that these debt limit standoffs come around once every couple of years and people are bored of them.
There's a little bit of muddling through, it feels to me, at the moment. We've gone sideways a lot on the headline indices. You've done okay if you've been in the European DAX or the CAC, but at a headline level. But there's a lot going on below the headline indices. How are you positioned? How are you playing this? And what are you keeping an eye out for?
Yeah, well, the short answer to your question is that for the last 6 weeks or so, we've actually been overweight equities. So we turned a bit more positive about equities in April.
Which equities?
Well, equities broadly, but the specific areas where we added at that point were to European equities and actually to NASDAQ, where we'd been quite circumspect before, but you had to recognise what was going on in terms of the market dynamics. But I think generally it was a reflection on the better mood driven by the traffic light system which we use, and what was driving that, driving us into the, shall I say, reluctant bull camp, was the recognition that momentum has significantly improved in markets. The technical picture is much better. It's not perfect. It's got a few glitches in it. But nevertheless, we've seen lots of golden crosses from markets and trends are turning upwards, and yet sentiment is still pretty negative. And that's quite a rare combination, where you get positive technicals, but actually investors still cautious and on the sidelines. The last time we saw that really was mid-2020. So that's not something to be ignored, because basically it tells you that if we get a bit of change in news flow, sentiment starts to warm up a bit, and the technicals are already a tailwind, then you can start to see markets open up. So that's the picture which we've seen over the last 6 weeks, albeit, we've been climbing a wall of worry. There's been a series of hurdles which we have to work through. We've gone through the first, which is the political. Now I think it's all about inflation, interest rates and growth again, which is where we were at the beginning of the year.
Could the technology story be sort of skewing the numbers this time round? The AI story has been just a sort of sole lone driver for quarters of the market, and we've got very narrow leadership at this point. Yeah. Those that are cautious are pointing to this liquidity squeeze that is coming, and that's from the Treasury refilling its coffers to what we're seeing effectively with the lenders tightening their lending criteria on the back of the regional banking crisis now. So could we actually be going into an environment that is somewhat unfriendly for investing?
Yes, so I think that's, these are all valid arguments. I think that they are probably largely factored in, but we are seeing it played out in terms of the underlying market dynamics. As Jeff said, there's the headline and then there's what's going on before. Now, I just said the technicals were getting better, and they are, but it's not actually as healthy a market as it was at the beginning of the year. So at the beginning of the year, we had a market rising with a broad advance. That all changed, really, with the regional banking crisis in the US. Since then, the market's continued to advance somewhat, but very, very narrow leadership, as you've said. So the market at large, that reflects basically a lot of these economic concerns, which you've just voiced. Will there be a credit crunch? Are we going to have a hard landing? Have we really got inflation back in the box? And that will just have to play out in the next few months. But actually, I think there are good grounds to think we're going to get some decent numbers on inflation. We could continue to see a benign run of inflation numbers. You just have to look at commodity markets for the clues about that. The nowcast for US inflation this month is 4.1%. Spain, just as an example, below 3% now. If we continue that progression to really, at least for the next few months, a progression to the less than 3% drop zone for inflation, and we don't have a hard landing, and let's face it, the economic data is still not bad, then I think that's what could start to shift sentiment from this sort of wall, the wall of worry, and it starts to, we may need to get a broader advance in markets. But I do believe we do need that. We need this advance to broaden out for it to be healthy.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.